Good evening, everybody. Today we are here to finish our assignments, to do a presentation of our assignments for question number 1 and number 2. So question number 1 is basically analyze the ratios and report on the ratio of ABC. So first ratio, right, is come to this liquid ratio. So Mohan will be the one who do the analysis of this liquid ratio. Mohan, pass to you.
Thank you, Jones. So once again, good evening, everyone. So firstly, we are looking into ratio, liquidity ratio. So liquidity ratio tells us the cash availability of the company to pay off its current expenses. So as per the calculated table, current ratio maintained its value from year 2021 to year 2022, but had slightly increased to year 2023. So the slight increase tells that the company has improved in terms of earning. However, the company still struggled to pay off its debt since the current ratio value is less than 1. On the other hand, the calculated value for quick ratios maintained from year 2021 to year 2022 and slightly decreased in year 2023. This tells that the company has taken risk to acquire liability, however, not having sufficient assets to liquidate to pay off its current liability. Similarly, with the current ratio, the quick ratio shall be more than 1 in order to be financially healthy to pay off its immediately liability. Thank you. I'll pass to the next person.
Okay. Thank you, Mohan. Let's look at the next slide. The next slide is talking about the activity ratio. So first come to the inventory turnover ratio, right? So you can see from the figure here, for the 3 years, figure is 1.95, 0.69, and 0.94. It indicated a decline in inventory management efficiency, but it has a slight improvement in year 2023. So it shows some recovery, but still indicate underperform compared to 2021 for 2022. So recommendations is maybe based on the 3 years record, this ABC company shall improve their inventory management practice, possibly have a better demand forecasting and inventory control system. And go to second and third average collection period and average payment period. You can look at the figure, 3 years figure. Their average collection period, right, indicate that it takes the company to receive a payment from its customer. It maintained a steady collections period in 2021 and 2022, improving significantly to 0.19 days in 2023. So improved the faster or better credit control and faster collections visible. On the other hand, the average payment period, right, indicates this company reduced its payment period from 091 to 067. So it means they can pay the supplier faster in shorter period. So come to 2023, also shorter period. So it means the company have strong liquidity to settle their account payables to their supplier. Based on the above ratio, so it shows that the ABC company must have taken right decisions or actions to improve their collection period. So it shall continue to improve their collection period. So it will give this company have more liquidity to pay their supplier faster, have better cash flow, then can have a better bargain power from the supplier to get a good price. So this is from this ratio for collection period and payment period. And last is the total asset turnover. So you can see from 2021 and 2022, there's big jump in 2022. So it's very extra phenomenon scenario, I would say. It maybe they just sell off an asset or decreases asset, or they suddenly have a big sales event in 2022. So it shows a tremendous jump in 2022 in terms of total asset turnover. But come to 2023, it comes back to 2.05. Still have some improvement compared to 2022. So my recommendation is the company shall do investigations on 2022. What have go wrong on this figure? Why it has such a big jump? Maybe there's a one-off event. So they may need to look at how to sustain this increase in terms of total asset turnover. So this is the analysis from my side. Come to next, financial leverage ratio.
Hi, good evening everyone. Okay, my name is Azri. Okay, I'm covering financial leverage ratio. For the ratio number 1 is a debt ratio. Actually, the debt ratio shows how leveraged a company is. It provides the insight into the proportion of a company finance derived from debt compared to its assets. all leverage ratio measure how much a company relies on borrowed funds versus its own funds on some level. The ABC company debt ratio has shown significant improvement, as you can see from the chart, from year 2021 to year 2023. The debt ratio for ABC company improved 253% from year 2021 to 2022 and 81% from year 2022 to year 2023. It can be interpreted as ABC company has reduced their borrowing significantly over 3 years, and at the same time the company has increased their total asset as well. The ABC company can improve its debt ratio by cutting its overall costs, reduce the liabilities, increase its revenues, refinance its current debt to lower interest charge or finance charges, increase the equity financing, and improve the cash flow. That's the recommendation for the first ratio. For the second ratio, the debt to equity ratio, DE ratio they call it, is used to evaluate a company financial leverage, and it is calculated by dividing a company total liabilities by its shareholders' equity. The DE ratio is an important metric in corporate finance because it measures the degree to which a company is financing its operation with debt rather than its own resources. So, for the ABC company, the DE ratio has increases since 2021 to 2023 from nearly 0.17 to 1.07. It indicates that the ABC company has increased their debt over the past 3 years. In general, the lower the DE ratio implies the company is in less debt and is risky to lenders and investors. For the suggestion, the ABC company can improve the DE ratio by increase its revenue and reduce the dependency to fund its operation from the capital market and uses its own funding. The company should reduce their liabilities and increase their asset, even though the increase of the asset could likely require new loan and would increase the debt. The company should put in place a better inventory management or restructure its debt if needed. The third financial leverage ratio is about time interest earn ratio, or they call it TIE. The TIE ratio is a solvency ratio that determines how well a company can pay the interest on its business debts. It measures the company's ability to meet its obligation based on its current income. The formula is for the company TIE is earning before interest and taxes EBIT divided by its total assets. In other words, the time interest earn ratio shows how many times a company can pay off its debts with its earnings. Okay, the ABC company shows some fluctuation in TIE ratio for over 3 years period. In 2021, the ABC company has TIE ratio of 0.37, which means its earnings are not able to pay off its debt and its earnings are less than its interest expenses. But the company has recovered by having 17.02 time ratio in 2022. But in 2023, the ABC company has deteriorated ratio by having 0.27. The ABC company has some fluctuation in its EBIT for the past 3 years, where in 2022, the company has a significant jump of its earnings from 2021 before it falls back in 2023. On the recommendation, the ABC company can improve DTI ratio by increase its earnings. The better earning would definitely improve the interest coverage ratio for the company. The company should decrease the expenses, pay off the debts, or to consider refinance the existing loan to a lower interest rates. Yeah, that's all from me. Thank you.
Okay, thank you, Nasri. Come to you, Fendi.
Okay, thank you, Jones. Thank you, everyone. I think that it's my turn to cover the most important part of all the ratios, and this is covered with the widest of ratio in the company, and the most important for all the company to have it, which is a profitability ratio. And then this ratio specifically focus on the company ability to generate profit, and that is the objective of all the company to use its resources efficiently. So it's clearly to show that from the table 4.0 indicated that ABC company profitability ratio from year to 2021 to year 2023. Based on the findings, the earning per share shows steady and also positive trends from the 2021 to 2023, whereas return on equity shows incremental trend from the year 2021 to year 2022, but it is a recovery and on the following years, which is increased in the 2023. However, actually we can find out the rest of the ratio, such as gross profit margin, operating profit margin, and also net profit margin, And also return on assets showed incremental constantly from 2021 to 2023. When I covered to the first one, which is the net profit margin, this reflect on the ABC company ability to generate earning after all the expenses and taxes are accounted for. It's obtained by dividing net income into the total revenue. Net profit margin is seen as a bellwether of overall financial well-being of the business. Okay, from table 4.0 indicated that over the periods, ABC company is not generating much profit from its sales, even they are keeping all costs under control. Company must improve on their sales because it accounts for all the expenses. It may reflect on time expenses on asset sales, that will be increased profit for just at that period. When ABC's company referred to the return, which is ROA, mean refer to their net profit and net income of the value earning from the sales after all the costs, expenses and taxes. The ROA is net income dividends by total asset. ABC Sindram has lesser ratio year on year. Asset the company have dissipated the sales and was decreased and potential lower profit for the company measured over the years. As economic scales affect higher costs and decrease of margin. Return of an ABC company must seriously look into the growing on a faster rate than asset, ultimately increase of return on assets. So last but not least is ROE, which is return on equity, is a key ratio for ABC company shareholders. As derived from the table 4.0, is measure a company ability to earn a return on equity investment steadily year on year. And the return on the equity is calculated of a net income by shareholder equity. ABC company increased without additional of equity investment. The ratio rise from on the 2023 due to the higher net income being generated from the larger asset fund, maybe with the debt. So it can be indicated that ABC company has ability to generate cash, not even rely on the debt. So maybe from the convert stock and also injection internal funds. Last but not least, I covered on the earning per share of ABC company. Net income is subscribed by the preferred share, or maybe by the dividend of by numbers of common shares. Earning per share of ABC company indicated a greater value, the periods and higher profits relative into the share price. This situation is good to the ABC company because it can invite the investor will pay more for the company share if they think the company is more profitable. From this, I can say, to cut it short, my recommendation towards this, since the company is profitable, ABC company should not further acquire liabilities, as this is will lead the company into the risky financial situations. Profitability in assets relative in the cost and expenses. The profitability is significant because they can indicate ability to make grow regular profits. And how well the ABC company manage investment for return for the shareholder. The bottom line, ABC company need improve the aspect of a company financial health. There are two main types of profitability ratio. First, ABC company should improve further margin ratio and also return ratio. Margin ratio measure ABC company ability to generate income relative to the cost. Second thing is a return ratio, measure how well the ABC company use the investment to generate return and wealth for the company and also the shareholder. In addition, I think that since the earning per share of ABC indicate greater value constantly from 2021 to 2023, so I think that is a greater value over the periods and higher profit relative to it per share. This situation is very good. Due to this situation, we invite more investor to invest to the ABC company because the investor will pay more for the company share if they think the company was profitability. So definitely the stock price increase. The next step is ABC company to do marketing activity aggressively and improve drastically their sale and generate more revenue organically. That's all from me, Jones.
Okay, thank you, Fendi. Let's look at the next slide. Next slide will be covered by Mohan. Mohan, come to you.
Yeah, lastly, we will be looking into the market ratio. So market ratio defines the stock value of the company. So based on the calculated table, it shows that a small gradual decrease in terms of a price earning ratio. So this indicates that the shareholder of the ABC company may not receiving a good dividends. However, the market ratio shows an increased trend, which is a good indication to get a new investor confidence on the company prospects. And to recap on the recommendation parts, ABC company shall focus on tapping a big market by branding their product, like advertising and impart knowledge to the customer, to the new customer. This will provide opportunity to increase on the current asset value. Thank you.
Okay, thank you, Mohan. So basically, we have concluded the answer for question number 1. So let's move to question number 2. This is a different company. is provincial imports per head. Our role is to work out their income statement and also their balance sheet. So this is the income statement of 2023. So based on the question given, the coming projected sales revenue is 6 million. So it increased by 20% compared to 2023. So we have to do formal income statement for year 2024. So given the questions and given some assumptions, let me do a quick explanation. Okay, how do we get this sales revenue? Basically, it's from the questions given. And how do we come up with this cost of goods sold, 3.1 million? The fixed cost of goods sold is 1 million in 2023. But the variable cost for goods sold should be 2.75 million minus 1 million. So it will be equal to 1.75 million. So the percentage of variable cost goods sold is 35%. The projected sales in 2024 is 6 million. So the cost of goods sold should be 6 million times 35% plus 1 million. So it comes to 3.1 million. So second is less the operating expenses. How do we get these operating expenses? In 2023, the fixed cost of the operating expenses is 250,000. So the variable operating cost is 850,000 minus 250,000. So it will be equal to 600,000. The percentage of variable cost of operating expenses to sales is 600,000 divided by 5 million will be 12%. If the projected sales in 2024 is 6 million, so the operating expenses is 6 million times 12%, it will be equivalent to 720,000. So the company purchased a new computer system in 2024. Okay, the depreciation cost for the year is 110,000. So it's considered one of the operating expenses. So that's why the total operating expenses should be 720,000 plus 250,000 plus 110,000. So it comes to this 1,180,000. So next is how do we get this tax 40%? After we have this operating profit, then minus the fixed interest expense, then the next is net profit before tax is 1,620,000. So minus the 40% tax, so we will get the net profit after tax. Then less the 40% cash dividend, it will give us a retained earning of 583,200. So come to balance sheet. Given by the questions, the information is 4 items will remain unchanged. A marketable security, not payable, long-term debts, and common stock remain unchanged. So the account receivable and account payable and total current liability is adjusted according to the sales revenue. The retained earning is projected 583,000. So we take 1,375,000 plus the new retained earning, it will come to 1,958,200. We couldn't get the balance sheet balance. Okay, there's still a gap between the total asset and total liability plus the stockholder equities. So from the questions, we need to assume or make assumptions. How does this gap come up from? So that's why we come up with this additional new common stock. At this point, I would like to invite Fendi and Nazri to give their opinion as a banker. How do we look at this gap from a company balance sheet? Fendi, why don't you start first?
Okay, thank you, Jones. Thank you for giving me opportunity to comment on these balance sheets, and I believe that by the other items that I'm looking is actually internal injections of internal fundings for common stock. Since we look at on the original common stock is only 75,000. So since the company doing well, this is the item that we are putting despite we having other external injection such as our bank finance. I believe that is a so-called of quite intelligent move due to to eliminate of all the finance charges, which is a cost towards of the company. So the company should take movement on the additional common stock as one of the key part in this their company, which is 346,800. So in order to balance out the balance sheets. That's from me, Jones.
Okay, Nazri, your turn.
Okay, thank you, Encik Fendi. I'm with the same opinion with Encik Fendi because from we can see here the director is pump in more money by getting the additional common stock, and then from other perspective, like we can see here the company for this pro forma balance sheet have a very good current ratio, most likely more than 2, and then the company can save on the finance charges by not going to the bank to ask for loan, additional financing. Even though from the balance sheet, I think the bank have no problem in terms of giving or financing or any project or giving some working capital for this company. And then it's like Encik Fendi said, it's a smart move by having the directors to pump in more money, and then the company can reduce its dependence of financing charges incurred for the company. Yeah, that's all from me. Thank you.
Okay, thank you. We have concluded our presentation for our question number 1 and number 2. So that's all for our assignments. Thank you very much. Okay.